Welcome back to Investing Talk podcast.
Good to be here.
You've shared some interesting material on HCW Biologics. That's a clinical stage biotech company. And, well, that sector always seems to have a lot going on.
It certainly does. Volatility is often the name of the game with companies at this stage.
So today, let's take the latest info we have on HCW Biologics and really try to understand what's happening. We'll look at recent news, their financials, the stock situation, their pipeline. Basically pull out the key insights.
Sounds good. It's about piecing together the puzzle from the available information.
And before we jump in, if you find these discussions valuable, please do subscribe, like the video, leave a comment. It really helps us out.
And maybe consider buying us a coffee if you're feeling generous. Keeps the lights on, so to speak.
Okay, let's get into HCW Biologics. There have been some pretty significant developments lately. The first quarter results for 2025 came out mid-May.
Right, covering the period ending March 31st.
Yeah.
And the headline figure there, I think, was the revenue.
It really jumped out. Just over $5,000 in revenue for Q1 2025.
Which is a stark contrast to the same quarter last year, Q1 2024, when it was around $1.1 million.
I mean, that's basically revenue disappearing almost entirely in that comparison.
It is. But interestingly, the net loss figure actually got smaller.
That's the strange part, isn't it? How does that happen? They reported a loss of $2.2 million this Q1 compared to a $7.5 million loss in Q1 last year.
Well, the details suggest it's mostly about where the money wasn't spent. Research and development costs were cut pretty substantially.
Down by about 30% to $1.5 million.
Correct. But on the other hand, general and administrative expenses, G&A, actually increased.
Yeah, those went up by 42% to $2.2 million. So the better bottom line seems heavily tied to that R&D pullback.
It seems that way. Cutting R&D is one way to reduce losses quickly, though obviously it has implications for future development.
Around the same time, they also completed a financing round, right? An equity offering.
Yes, a $5 million equity offering, completed with just one institutional investor.
And it was structured as units, about 671,000 of them, priced at $7.45 per unit.
And the information provided was quite specific about the intended use of those funds.
Which is always interesting to see. What did it say?
It indicated the money is earmarked for two main things. First, opening clinical trial sites for their Phase 1 study of HCW 9302.
That's the one for an autoimmune condition like alopecia areata.
That's the one. And second, funding studies to support business development, specifically aimed at finding a licensing partner for their immune cell engagers platform.
So tying the cash directly to advancing the pipeline and seeking partnerships. That makes sense.
It shows clear operational goals for the capital raised.
Now, another important piece of recent news involves their Nasdaq Q listing.
Ah, yes, their stock market listing status. They received an extension back in March.
An extension from the Nasdaq hearings panel to stay listed on the Nasdaq capital market. But it came with strings attached, didn't it?
It did. There were deadlines. They apparently had to meet the minimum bid price rule by late April, which the extension implies they managed, at least temporarily.
But there's another deadline coming up fast.
Right. They need to meet all other Nasdaq Q listing requirements by June 15th. That's very soon.
That sounds like a critical point hanging over them. Okay, let's connect this to the market reaction. The stock price has been, well, volatile.
That's putting it mildly. The information describes really significant volatility in 2025.
How significant are we talking?
Well, the stock was apparently trading above $14 in, previous periods. But the forecast mentioned for June's average price is way down, somewhere around 69 cents a share.
Wow, from over $14 down to potentially under $1. That's a massive drop. So what's behind that kind of collapse?
The available info points to a few key factors working together.
Like what? What's driving it down so hard?
First, there are the dilution concerns. That $5 million equity offering we mentioned, it brought new shares onto the market.
At a price much lower than where it used to trade.
Precisely. Issuing new shares, especially at a lower price point, increases the supply and can put downward pressure on the existing share price. Simple supply and demand, partly.
Okay, so dilution is one factor. What else?
Second, you have the broader market environment. The reports mention that the whole biotech sector is facing headwinds.
Because of high interest rates and maybe less investor enthusiasm for risk?
That's it. Especially for these early-stage companies that don't have revenues yet. These wider economic factors can really amplify a specific company's problems.
So it's partly being dragged down by the sector trend?
It certainly seems to be contributing. And third, there's that listing uncertainty we talked about.
Even with the extension, the fact that they still have this June 15th deadline looming, That worries investors.
It can, yes. Uncertainty about maintaining a major stock exchange listing is often a negative for investor confidence. Any potential risk of delisting is usually viewed poorly.
And the analysts covering the company, what's the general feeling there?
The sentiment described appears cautious. That caution seems tied directly to the financial struggles, the low revenue, the need for funding, and that ongoing reliance on raising cash.
It highlights how precarious their financial footing is right now. Let's dig into that financial health a bit more. Beyond just Q1, what does the bigger picture look like?
Well, the revenue trend over the last couple of fiscal years wasn't great either. It actually decreased from 2023 to 2024.
From about $2.8 million down to roughly $2.6 million.
Something like that, yes. And then, of course, Q1 2025 saw that near total drop-off we discussed. So it shows a real challenge in building consistent revenue.
And profitability is obviously not there yet.
No, definitely not. Earnings per share, EPS, is negative because they're operating at a net loss. This isn't uncommon for R&D-heavy biotechs, but it does reflect operational challenges.
Which means things like a price-to-earnings ratio aren't really meaningful here.
Correct. You can't calculate a PE when earnings are negative. Again, typical for the sector at this stage, but worth noting.
What about their debt situation?
The Q1 figures mention net debt around $7.4 million, and total liability is close to $37 million.
That sounds like a lot of liability.
It does suggest a significant debt burden relative to their current operational scale, though we don't have the exact equity figure from the reports to calculate a precise debt-to-equity ratio.
And cash flow must be negative too, right? Given the losses.
The information strongly implies negative cash flows, yes. With operational losses and ongoing R&D, even at reduced levels, they're likely burning through cash.
Which impacts things like return on equity.
Right. ROE would also be negative because net income is negative. It suggests, compared to potentially more advanced peers, an inefficiency in generating returns on shareholder investments at this point.
But the most critical financial point highlighted was that going concern warning.
Absolutely. That's language directly from SEC filings cited in the materials. It means there's substantial doubt about the company's ability to keep operating for the next year unless it secures more funding.
That's about as clear a red flag as you can get financially.
It really is. It underscores their dependence on raising more capital.
Okay, let's shift gears. Despite these financial headwinds, there's potential here, right? What's the core business? What are they actually trying to do?
Their focus is on developing proprietary immunotherapies. The core idea is tackling diseases by interfering with the link between chronic inflammation and various age-related conditions.
Inflammation and aging, an interesting connection to target. What diseases specifically?
The reports mention pancreatic cancer and ovarian cancer as key targets, along with other conditions linked to aging.
And they have actual drug candidates progressing.
Yes, the pipeline is presented as their main strength. 2 compounds are often highlighted. HCW 9206 is mentioned as being closer to a potential commercialization.
Which could be a big deal if it happens actual product revenue.
Potentially, yes. And then there's HCW 9302. The FDA cleared them to start a phase 1 trial for this one.
That's the one for alopecia areata we mentioned earlier, funded by the recent offering.
Exactly. That FDA clearance for the trial is noted as a positive regulatory step. They also mention their drug discovery platform, TRBC, as part of their innovative engine.
So the story seems to be significant financial stress, but holding on to the promise of this specific pipeline and technology.
That's a fair summary of how the situation is presented. The pipeline is positioned as the key asset and potential future value driver, despite the current financial difficulties.
Right. So let's circle back to crystallize the main risks again. What are the absolute must-watch challenges?
Number 1 is clearly financial stability. Low revenue, the need to constantly raise funds, and that explicit going concern doubt. That's paramount.
And number 2?
Regulatory compliance, specifically meeting those Nasdaq Q listing standards by June 16th. It's an immediate make-or-break deadline.
How do they fit into the competitive landscape? Who are they up against?
Well, they're in a tough space. The reports mention competition from big established pharmaceutical and biotech companies. Names like Gilead Sciences, Regeneron, Moderna Therapeutics are cited as examples.
Companies with vastly greater resources.
Much greater resources, yes. So HCW Biologics is positioned as a smaller challenger, trying to prove its technology through trials and potentially find partners.
Their specific focus on inflammation and age-related diseases via immunotherapy is their potential differentiator, then.
That appears to be the angle, yes. If their drugs show unique efficacy or safety advantages, That could be their edge against the bigger players.
Did the information give any sense of sort of public buzz or social media sentiment?
Interestingly, it noted a lack of detailed social sentiment data readily available. That could mean a few things. Maybe the public discussion is limited, or perhaps it's more focused on the stock's price action rather than the underlying science.
Okay. So putting it all together, based only on this information, what's the outlook? Are there potential bright spots on the horizon?
The potential catalysts highlighted are pretty clear. First, if HCW 926 actually reaches commercialization, that could change the revenue picture.
If and when that happens.
Right. Second, positive data coming out of that HCW 9302 phase 1 trial, the one for alopecia, would be a significant boost, especially since the recent funding is tied to it.
And the third potential catalyst?
Securing a licensing partner for their immune cell engagers. That was another stated goal for the recent funding round. A good partnership could bring in cash without selling more stock and validate their platform.
And future earnings reports, obviously, will be watched closely.
Of course, any sign of stabilizing financials or unexpected revenue would be noted, but
the major risks are still there, casting a shadow.
absolutely. The Nasdaq Q compliance issue by June 16th is immediate, and the overall market conditions affecting their ability to raise more money, which seems almost inevitable they'll need, remains a huge factor.
Given their cash burn rate, future funding seems critical.
It appears essential based on the financials presented.
So, how is an investment in HCW Biologics ultimately characterized in these materials?
It's consistently described as speculative, high risk due to the early stage of the pipeline and the very real financial challenges.
But with potential upside if the science works out.
Precisely. The potential for breakthroughs is the opportunity. So it's often tagged as maybe a hold or a speculative buy, but only for investors who have a very high tolerance for risk and understand the challenges involved. Caution is heavily emphasized.
That gives a really comprehensive view based on the information provided, the struggles, the potential, the deadlines. It's quite a situation.
It definitely is. And synthesizing all this does bring up a fundamental point to think about. How much weight should you give to an early-stage biotech company's long-term scientific potential and the promise of its pipeline,
Compared to
significant, very real, near-term financial instability and critical regulatory hurdles, like that Nasdaq deadline, when you're trying to evaluate its prospects?
That's the essential balancing act, isn't it? A great question to ponder. We'll leave you with that thought. Thanks for joining us for this analysis.